Hey, this is Sasha. Thanks for joining me in today's episode. And today what we're going to do is we're going to take a look at Iron Condors, and we're going to look at how do they work and how do they make you money. So stay tuned. I'm going to share with you this insight in this video. All right, so if you don't know what an Iron Condor is, I'm going to break it down for you here in this video and show you how they really work and function and how they make you money. But if you want to get a more detailed explanation, I would definitely recommend you check out our website at tradersfly.com. There's a great getting started guide on option trading, and there's even a free option trading mini course that you can check out. So check those things out. It's like a 6-part series or so, and it'll go in quite a bit of detail into options. Anyways, with that being said, let's go in and take a look at how an Iron Condor works. Okay, so an Iron Condor, in a basic sense, it works by selling option premium. Okay, and why do we sell? Well, think of any business. Why does any business, how do they make money? Do they make money by buying or selling? Right? Think about it. Do they make money by buying or selling? If you own a grocery store, you make money when you sell items. Now, yes, you have to own it first and buy it, but then will you make money when you sell it? Now, what's great about an Iron Condor is you can sell first and buy back later, in the same way that I could go ahead and post something on eBay first and say, hey, I got a camera for sale, even though I might not have it. I have it for sale, and I list it and somebody buys it, and now all of a sudden, oh man, I gotta go get it. So if I can get one at the store for $500 and I sell it for $550, I've still made the money. Doesn't matter if I sell first, as long as I deliver and accomplish the legal obligation. So in this case, what we're doing first is we're selling you something first, just like a dealer would sell a car first for you and then deliver it later, maybe after manufacturing. So we sell first and then we buy it back later. So with an Iron Condor, we sell option puts and we sell option calls, and that creates basically a strangle for us. Okay, so once we have a strangle, and then what we do is we buy protection, which is these wings right here, after to protect it. So let's go on screen here in a minute, and I'll show you how that works. Okay, so if we were to do this on screen, and let's go with Adobe, the base concept of 50 days out, and current stock price, just to give you a reference on the chart right here, is right around $500. So we go to the trade tab, we'll go 50 days, and let's say we go a little below that, insuring the stock for somebody else at about 440. So we sell a single, just to show you. Okay, now we've got this side, so we're insuring it on the downside. And then I'll do the other side over here and sell the call side. Not the vertical, but we'll sell the single. Okay, and now I'm insuring it on the upside. So this creates kind of a strangle for me. A straddle. Straddle. They all sound similar to me, because if you sell a strangle, you know, this is what it is. It's a spread that's out wide. So that's what you're doing. Anyway, strangled. So now we've got this strangle right here, and the way that it functions is that with time, because of option premium, you collect this theta. So every day that stock stands still, you make that amount of money, that theta. So with time, as I move this time forward, theoretically they decay and expire. So what is this curve? What is this all about? Okay, so let's break it down a little further. For those of you that are, let's rewind it a second for those of you that are new. If I sell a put, insurance, right? If I buy a put, normally I need the stock to go down. But since I'm selling, I need it to go up because I'm a seller, I'm insuring it. And now by insuring it this way, with time, I make that premium. This white line is the line today. The green line is at expiration. This curve at the, this axis on the bottom is the stock price. Here's our zero line. So as we're above that line, I make money. If we're below, I lose money. So I want to stay above it. And if I bring it in a little closer, let's say 480, I can make more because now the risk is higher, so I'm getting bigger insurance, right? Or I'm selling more expensive insurance. Now, here's the call side, same thing. I can bring it in. And now together, this gives me that strangle, okay? Now, that's the base concept. You're selling option premium to make money. And with time, you have time of $34 a day. That's what you're collecting. And as long as it's in that range, you're making money. Now, if it goes outside of that range or starting to move against it, you could get out of it early. There's no problem with that. You could get out of it in 5 minutes. But with an Iron Condor, what you're doing here is, here's the problem with this spread. Your risks are in the business considered unlimited because they go pretty much there and there all the way to the downside till zero, pretty much unlimited. So with an Iron Condor, you buy a wing to protect yourself. So I'll buy something, let's say, 20 points difference from my one side, and now I've got that side protected. And I can do the same thing over here on the call side and just go, let's say 550, and instead of selling, I'm going to buy it. And now I've got an Iron Condor. So there we go. I've got that Iron Condor spread, and that's what an Iron Condor is. Now, the difference between all of these, though, because the ones I'm buying versus the ones I'm selling, I'm only getting a 7 theta. Because if I did it without the protection, okay, I get 32 theta or time per day. And then that protection costs me about 24 per day, because here I'm buying that strangle, but I'm buying a cheaper one. So losing $24 a day, but making 32 a day. In total, I'm making about $7 or $8 per day. So not a boatload compared to the strangle, but with time, you can see that theta continues to accelerate, and then every day you're making a little bit of money. And as long as it's kind of in that range, hanging out, you're good, you're fine, you're doing your thing. So that's the way that an Iron Condor works, and that's how you make money. You could get out of it a little sooner if you like. You could get out of it a little later, leave it till expiration if you like. And what you can do is you could construct, let's say you're a little more bullish, I could put 3 contracts on the put side, okay? 3 contracts on, this is the call side, so we'll do 1 contract here, 3 contracts on the put side, and leave the call side with 1 contract. That way I'm a little more bullish, okay? I could do it a little bullish, I could do it a little bearish. There's a lot of things you could do with it. They're very flexible strategies, so it really just comes down to how you structure the trade. So I hope this was helpful and gave you some things to think about. Definitely check out that mini course if this was confusing for you, or the Getting Started page here. And you can see some of the live classes that we might have coming up as well on this website, or one-on-one coaching if you want to work together and meet on video as well. So thanks for joining me. Hope you enjoy the rest of the day ahead, and I will see you in the next video.